Hello everyone, this is Miftah. Today I'm going to discuss money market and quantity theory. We often ask why can't the government just print unlimited money and make everyone rich? Sounds simple, right? But here's the catch. If money grows without real production, prices shoot up. That's why printing money doesn't create wealth. It creates inflation. In this video, I'll break down the money market and the quantity theory of money. You'll see how money supply connects directly to prices and output, and why central banks step in to keep inflation under control. By the end of the video, you'll know exactly how it all links to your daily life, from the price of bread to your loan interest rate. Now, the first thing to know is the quantity of money. That's the total money circulating in the economy, not just the cash in your wallet, but also deposits in banks that you can spend. Think of it like water in a tank. Too little water, plants dry up. Just like too little money, slow trade. Simple. Again, too much water and it overflows. Just like too much money causes inflation. Now, the orthodox theory, the famous equation, the heart of the quantity theory is one equation, which is m multiplied by v is equal to p multiplied by y, where m is money supply, v is velocity of money, which indicates how fast the money circulates, p is price level, and y is the real GDP. Also could be summed up like actual goods and services produced. So MV equals nominal GDP, which is the economy's value at current prices. Here's the key: if money supply goes up while the output stays the same, then prices must rise. That's inflation. In Zimbabwe in the 2000s, the government planted trillions. Sorry, pardon me. Mm, the government printed trillions. Output didn't grow, but the prices exploded. At one point, a loaf of bread cost trillions. I repeat, trillions of Zimbabwe dollars. So now, uh, there is a mm, there is a direct relationship. There is a direct relationship if the velocity of money and the real GDP are constant, then money is directly proportional to price level, which indicates to more money means higher prices. Imagine an economy produces 1,000 goods. If 10 grand circulates, if 10 grand circulates, the average price is about $10. But if suddenly 20 grand circulates while the goods stay at 1,000, the average price doubles to $20. That's how money supply directly influences prices. Now, we have the money demand and supply graphical representation in the long run. So in the long run, the central bank controls the money supply, and in diagrams, that supply curve is shown as the vertical line. As you can see, this is the supply curve. The red dotted line is the supply curve, which is the vertical line, which is independent of the interest rate, by the way. That's why it's the vertical line. Now, the demand for money, however, slopes downward. The blue curve is the demand for M subscript D curve, or also known as the demand for money curve, which is a downward sloping. Why? Because when interest rates are high, people prefer investing instead of holding cash. When rates are low, people hold more money. And here's a simple part where the vertical supply line and the downward sloping demand curve meet. That intersection sets the equilibrium's intersect rate. Example, during COVID-19, the US Federal Reserve slashed rates close to zero. This encouraged borrowing and spending, helping demand recover. Now, the very interesting and intriguing topic about the functions of central bank. They play a crucial role in managing economy through various policies and tools. Okay, so to sum up the 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 role of central bank, to put it in a funny and a gentle way, I must say that central banks act like referees of the economy. Their two big jobs are monetary policy, adjusting interest rates and money supply, and supervising banks, which is keeping the system stable. Well, a question might pop up in your mind that what is their goal? What are they trying to achieve? So it's simple, basically. It's just balancing growth while keeping the prices stable. That's it. That's their goal. That's why they play a crucial role in the economy. Now, the central banks mainly use three tools. The first one is open market operations, also known as OMO, which is buying or selling government securities to control the money supply. And then we can find the reserve requirement ratio, and which is how much the bank must hold in reserve, and the discounted slash the bank rate, interest rate at which banks can borrow from the central bank. So these are the monetary policy tools I've discussed earlier and explained everything in simpler words. Now, each tool increases or decreases the money supply. For an example, after the 2008 financial crisis, central banks bought huge amounts of securities, injecting liquidity. This was called quantitative easing, basically a large-scale OMO. Now, to understand the OMO and liquidity management, think of the central bank like a tap, like a water tap. Buying government bonds means opening the tap, adding more money. Selling bonds means closing the tap and draining the money out. This is one of the most powerful ways they control inflation and stabilize interest rates. Now, treasury bill operations and money supply effects. When the treasury bills are sold to commercial banks, central banks gets the money, and as I have discussed here earlier, that money is directly proportional to price level when the real GDP and velocity of money are constant. So the money supply decreases, the price level also decreases, then the money is removed from the market, which is also known as the mop up of money. Now, when treasury bills are bought from commercial banks, central bank gives money to them, money supply increases, which results in the increasing of the price level, which means money is injected into the market, which also refers to mop down of money. Now, to fine-tune the money supply, central banks use repos and reverse repos, so it is a very short-term investment. They typically days or weeks. Treasury bills, which is also a short-term investment up to 1 year maximum. Bonds are long-term investments, which is 5+ years. These tools give them flexibility, quick fixes, or long-term stability. Okay. Now, the relationship between money and the output. In the short run, increasing money supply lowers interest rates, boosting borrowing, investment, and GDP. I repeat, in the short run, increasing money supply lowers interest rates, boosting borrowing, investment, and GDP. I hope you got the point. If money keeps growing without real reduction, the economy overheats and inflation takes over. For example, we can take that in the 1970s, the US suffered stagflation, which is inflation plus stagnant growth, caused partly by the excess money supply and oil shocks. Now, mm, increasing money supply, lower interest rates, increased in investment and consumption, higher economic output, these changes, these can influence economic output. Okay, generally, an increase in money supply can stimulate economic activity, leading to higher output. Now, so here is the big takeaways: printing money doesn't make a country rich; it just makes prices rise. Okay, so the quantity theory of money shows the link between money supply and prices and output. Central banks are constantly walking a tightrope. Add too much money and inflation takes off. Add too little and the growth stalls. Okay. So if the growth stalls, then I mean the economy will collapse, right? Yeah. So history has shown us both sides: stability when managed well, chaos when mismanaged. So it's better to be to hope for a managed and stable economy. If you enjoyed this breakdown, don't forget to like this video, drop a comment on what topic you would like next, and hit subscribe so you don't miss more simple yet intriguing life lessons and interesting topics. That's it. Sayonara.